Hey there, and welcome. Have you ever stopped to think about how a massive company, say a Sony or a Samsung, manages its cash across literally dozens of countries? It's fascinating because once a business goes global, finance isn't just about balancing the books anymore. It becomes this incredibly high-stakes strategy game. So today, we're going to open up their playbook and see exactly how they win. So really, how do they pull it off? I mean, think about it. A company with headquarters in Japan, factories in Vietnam, and customers all over Europe, how do they keep all of that money, all those different currencies flowing in the right direction? It sounds like it should be simple, but the reality is a crazy complex web of currencies, taxes, and risks. The best way to think about it is like a global chess match. Winning isn't about getting lucky, not at all. It's about having the right playbook. And that's what we're going to do here. We're going to break down the 3 core strategies, the essential plays, that the most successful multinational companies have absolutely mastered. Okay, but before we get into the winning plays, we first have to understand the playing field, because going international isn't just like opening a new office in the next state over. It's a completely different game, with a whole new set of rules and, you guessed it, a ton of new challenges. And what's wild is that a company that only operates in one country doesn't have to worry about a single one of these things. But for a global firm, all of a sudden you've got currencies swinging wildly, different tax laws everywhere you look, political drama that could pop up overnight. Heck, you could even have your profits literally trapped in a country. Any one of these can completely derail a project that's otherwise doing great. All right, so with all those risks in mind, let's open up the playbook. Play number 1. This is all about the huge, big-ticket decisions. We're talking about questions like, should we spend $500 million to build a new factory in another country? This is the world of what they call international capital budgeting. Let's just make this super simple. Imagine a US company wants to build a brand new factory over in India. The second they do that, their financial world splits right down the middle. It's not one picture anymore. Now they've got to track 2 totally different streams of cash. And this right here, this is maybe the most critical idea in all of international finance. On one hand, you have the project cash flows. That's the profit the factory in India is making, counted in Indian rupees. And hey, that number might look fantastic on paper. But what really matters is the parent cash flow. That's the actual money, the US dollars, that make it all the way back home after you pay Indian taxes, after you swap rupees for dollars, and after you deal with any rules about sending money out of the country. So, with all these weird new risks, how do you even figure out what a project like that is worth? You can't just use your standard old formula. That's why finance pros use a special tool called adjusted present value, or APV. Just think of it like this. You're building a price tag from scratch. You start with the project's basic value, and then you start adding in all the unique international stuff. You add value for a sweet tax break the host country gave you, but you subtract value for the risk of political turmoil. It gives you a much, much truer picture. So, the bottom line for our first play is really simple. Yeah, you want the local factory to be profitable, of course you do. But at the end of the day, the only number that truly matters is the cash that makes it back to headquarters. That's the real measure of success. Okay, so that leads us right into our second play. Building those factories costs a ton of money, right? So where does all that cash come from? Well, if you're going to have a global operation, you need global funding. Let's see how these companies raise the massive amounts of capital they need to grow. One of the coolest tools they have is something called a depository receipt. The easiest way to think of it is like a passport for your company's stock. An Indian company, for example, can't just sell its shares on the New York Stock Exchange, but they can give them to a big bank, and that bank issues a special certificate, an ADR, that can trade in New York, in US dollars. It just makes it super easy for investors from anywhere in the world to buy a piece of your company. But that's just one tool in the toolbox. As you can see, there are a few main options, and each one is for a different strategy. If you want to sell ownership to investors all over the world, you use things like ADRs. If you want a cheaper loan now and you're okay with maybe giving up some ownership down the road, you use a clever hybrid called an FCCB. And if you just need to borrow a huge pile of cash and want to avoid your home country's regulations, you issue something called a Eurobond. So the big takeaway for our second play is pretty clear. When companies go to international markets for money, they're not just finding more money, they're finding a bigger, better toolbox with way more options to fund their growth in the smartest way possible. And that brings us to our third and final play. Now, if the first two were all about long-term vision, this one is about what happens day in and day out. It's about managing the constant flow of cash around the world. Imagine trying to manage your family's budget, except you're doing it in 10 different currencies all at once. Here's the problem every big global company faces. They're basically a giant, messy web of different divisions buying and selling stuff from each other. The team in France buys parts from the team in Germany, who then sells the final product to the team in the UK. If you don't have a smart system, that turns into a chaotic mess of payments flying back and forth, and every single one costs money in bank fees and currency exchange fees. It's just a massive waste. The solution is this really elegant idea called netting. It's brilliant. Instead of all that messy back and forth, every payment that needs to be made is reported to one central account. So maybe the German unit owes France 10 million and the US 5 million, but the UK owes Germany 8 million. The system does the math and says, hey, Germany, just make one single payment of 7 million and we're all square. It's a simple idea that cleans up the whole mess and saves them millions in fees. Now, here's another really clever tactic. It's basically about timing your payments perfectly. It's called leading and lagging. So let's say your subsidiary in India has a big bill to pay in Japanese yen. If your team thinks the Indian rupee is about to get weaker, you lead. You pay that bill right now before your money is worth less. But if you think the rupee is going to get stronger, you lag. You wait as long as you can to pay, so the exchange rate moves in your favor, and the bill actually gets cheaper. Pretty smart, right? And that really gets to the heart of our third play. Smart day-to-day cash management isn't just about cutting costs. It's a strategic weapon. It lets you minimize waste, lower your risks, and even turn the danger of changing currency values into a real financial opportunity. So there you have it. Those are the 3 core plays in the International Finance Playbook. You can see how they all fit together, right? They're like pieces of a giant, complex puzzle, and a company has to get every single piece right if it wants to really succeed on the world stage. So let's boil it all down. What's the winning playbook? It's really these 3 rules. First, when you're making those huge bets, focus on the cash that actually gets back home. Second, go global to find cheaper and more flexible ways to fund your growth. And third, become a master of your daily cash flow to cut costs and turn risk into an advantage. Which leaves us with just one final thought to chew on. In a world that seems to be getting more and more unpredictable every day, which piece of this puzzle do you think is going to be the toughest for companies to solve next? Is it going to be making those big investment decisions, finding global funding, or just managing the day-to-day cash?